Every major economic shift is preceded by the same strange feeling. Things seem fine. Jobs still exist. Markets still trade. Stores are still open. Life appears normal. And that's exactly why big shifts are rarely believed until after they happen. The real mystery isn't why economic shocks occur. It's why they almost always arrive when confidence is highest. History shows this pattern again and again. And right now, the US economy feels eerily familiar. Setting the stage. Comfort is a dangerous signal when people imagine economic danger. They imagine panic bank runs, mass layoffs, collapsing markets. But those are late-stage symptoms. The most dangerous moment in an economic cycle is not when fear dominates, but when comfort does. In 1929, consumer spending was strong. In 2007, housing prices felt unstoppable. In early 2020, markets were near record highs. In each case, the system didn't look broken. It looked stable. That stability wasn't real strength, it was momentum masking fragility. Origins. Why stability becomes an illusion. Every major economic shift begins with a long period of success. Growth builds confidence. Confidence encourages borrowing. Borrowing accelerates expansion. At first, this works. Debt fuels investment. Liquidity supports markets. Intervention smooths volatility. The system becomes efficient at preventing small shocks, which ironically makes it vulnerable to large ones. Because over time, risk doesn't disappear. It hides. The rise. When support replaces resilience as cycles mature, policymakers step in to stabilize outcomes. Interest rates are adjusted. Liquidity is injected. Backstops are introduced. Each intervention solves an immediate problem, but changes behavior. Markets begin to expect support. Businesses rely on cheap capital. Households adapt to rising asset prices. This creates a critical shift. The economy becomes dependent on stability itself. At this stage, everything still feels fine. But the system is no longer resilient, it's fragile but supported. The breaking point. When small triggers cause big moves, breaking points rarely come from obvious disasters. They come from misalignment. Costs rise faster than incomes. Debt grows faster than productivity. Policy tools lose effectiveness. At some point, a small change rates, liquidity, confidence ripples through a system stretched too tightly. And when that happens, adjustment happens quickly. Because stability was artificial. The system wasn't prepared for stress, it was conditioned to avoid it. Why it always feels fine before it doesn't. Here is the key insight most people miss. Economic systems don't fail when people expect failure. They fail when expectations are wrong, when businesses assume demand will continue, when consumers assume prices will stabilize, when investors assume liquidity will remain available. That assumption gap is where shifts happen. By the time fear appears, the shift is already underway. Fallout. When reality catches up, once the shift begins, reactions accelerate. Markets reprice. Credit tightens. OCN FIDEN CE erodes. What felt fine weeks earlier now feels obvious in hindsight. People ask, how did we miss this? Why didn't anyone warn us? But warnings existed, they just didn't match emotions. Because emotionally, everything felt normal. Failed fixes. Why repeating the cycle is easy. After every shift, reforms are proposed. Better regulation. Stronger oversight. Smarter policy. And some improvements are made. But over time, memory fades. Success returns. Risk builds again. Comfort replaces caution. The same incentives reappear, short-term growth over long-term stability. That's why the cycle repeats. Not because people are irrational, but because systems reward optimism. Modern parallels. Why this moment feels familiar today. Many indicators look okay. Employment appears resilient. Spending continues. Markets function. But beneath that surface, debt levels are historically high. Policy flexibility is limited. Global conditions are unstable. This combination has appeared before, right before major adjustments. Not collapse. Adjustment. And adjustments are disruptive, precisely because they arrive quietly. Why awareness matters more than prediction. This isn't about predicting a specific event or date. It's about recognizing conditions. When an economy feels fine despite visible strain, it's usually because momentum is carrying it forward. Momentum is powerful but temporary. Understanding that difference changes behavior. 3 clear takeaways. First, economic shifts don't announce themselves with panic, they begin during periods of confidence. Second, Stability created by intervention can mask fragility rather than eliminate it. Third, the most important warning signs are emotional. Not numerical. When everything feels fine, systems are often most exposed. Final thought: the US economy doesn't feel fine because nothing is happening. It feels fine because the system is still moving on past momentum. History shows that momentum runs out quietly, then reality reasserts itself quickly. The question isn't whether change is coming. It's whether people will recognize the pattern before hindsight makes it obvious. If you want more deep analysis on economic cycles, hidden risks, and the patterns history keeps repeating, subscribe to the channel. Because the biggest shifts don't happen when everyone is afraid. They happen when almost everyone feels comfortable.